evolution of a business owner. Okay? So when you start out, you often start out self-employed, right? You don't incorporate yet, right? You have an idea, maybe you sell some products, a service, and then all of a sudden your income gets to a certain level and it gets high. Well, now you're in a high tax bracket, right? So you incorporate, right? Now you're great, so you incorporate, and there's a lot of advantage for incorporating. But then in incorporating, now you're dealing with other issues, passive income, for example, okay? So every time you think you're moving forward, you move backwards, right? So you're like, okay, got it, I better do something about that. So you set up a holding company, right? That's a great idea, but guess what? Now you're back up to high tax brackets again, right? And you're going to lose your capital gains exemption. So all these negatives. I'm going to dig into this a little more, okay? So we're like, okay, I know how to do, I'll figure it out. I'll set up a family trust. Sounds good, right? Well, now you got this 21-year rule that every 20 years everything gets taxed. So we're like, oh my God, like there's nothing that keeps, improving. There's always a step backwards. So that's where we get into something a little more creative, a little more advanced. That's what we're here for, right? We're getting into things that you might have heard about, infinite banking, IFA, which is immediate financing arrangement, or even just some general estate planning. Okay, so this is how it evolves. As you start to get more successful, you start to find there's more problems with success, right? I always say that. It's great to be successful, but you just have bigger problems. Okay, so let's just back up and go through that evolution. So step one, we talked about being self-employed and that high tax bracket, right? So what does that look like? So and why did you incorporate? Let's go through that. There we go. These are the personal tax brackets. If you haven't looked at this in a while, in Canada, if you make over $220,000 a year, you're at 53.53%. That's stupid. You're working more for the government, right? It makes no sense, okay? And 53%, I actually have a tax guide from 1957. In 1957, if you made over $200,000, you would be paying 90% tax. Okay, that was after the war, and they were trying to recover the money they spent. 90%. Why even bother making any money? Right? That's ridiculous. So 220. Now that is that's the marginal tax rate, which means your dollars after that get taxed at 53%. Right? So depending on where you're at, you might still average out lower. Okay? But again, that's why you incorporated. That's why you looked at corporate tax rates. And if you're in the small business income of under $500,000, you qualify for 12.2% tax. That's a huge difference between 53%, right? And even if you're over $500,000, you're only at 26.5% tax. Okay? Which when you look at all of that, it's a considerable savings. So if you've earned, let's say here, $250,000, instead of $95,000 personal, you've paid $30,000. You've paid 31% of the actual tax amount. Only a third. Right? Even if you're at $500,000, you've only paid 39%. So still, incorporating still works. But the problem with incorporating is this works if you leave the money in the company. As soon as you pull it out, you're going to be taxed with that 53.53%. You're stuck again. Okay? So it's this endless loop that you think you're moving forward and you're not. There's other reasons you incorporated, right? You now have flexibility of how you pay yourself income, right? So in the past, you had a choice between salaries and dividends used to be very, very attractive. Not as much anymore. Still a bit of an advantage, not as much, okay? And this is where having a solid accountant will help you figure out how much do you pull out and how do you pull it out, okay? You can pull it out when you need it. You can split with family members. Even that, splitting with family members, even that is getting tricky, okay? We'll talk about that in a little bit. They actually have to work. There's a few rules around that as well. But again, you can have multiple shareholders, so you can pay dividends to multiple people. So now you're getting more creative on how to pull money out. But again, as soon as you pull money out, whether it's to you and your spouse, you're going to be taxed personally again. Okay? You're also getting protection, right? Because you incorporated. Now if you get sued, they're not going to attack your home. So that's nice, right? Unless you're, I don't know if anybody's a doctor, a lawyer, or a realtor, they're still personally liable. Even though they have a company, they can still be attacked personally. So anyone in a service like that doesn't get that protection. Or if you know you're about to get divorced and like, ooh, I better hide my assets, yeah, that doesn't work either. So don't think of that, okay? And the other thing is the LCGE, the lifetime capital gains exemption. So this is important, right? So when you have a company and you sell your company, the first $1 million is basically tax-free. Okay? So right now, the current exemption is $971,000. So I assume you've all started your company from scratch, from zero. It means your cost base is zero. That's what it's, maybe a little bit of, maybe you put your own capital in, but, basically you started from scratch. If you sell your company for $1 million, basically you pay no tax on that. Okay, that's nice. Now, if you started your company with your spouse, let's say, so there's 2 shareholders, you get that times 2. So you can sell your company for $2 million tax-free. Okay? Now, the actual savings on a capital gain like that, that's 971 capital gain. Capital gains are half taxable, so 500,000. So it actually saves you about 240,000 in tax. So it's money. It's money. And again, if you have your spouse, that doubles it. If you have more shareholders, that doubles it. Okay? Yes, per shareholder. Perfect. Okay, but there are disadvantages in incorporating. Okay? One is the kiddie tax. So the kiddie tax basically, and just bring it all up here. Okay? So the kiddie tax basically says that if you pay your young children income or a dividend, it's going to be taxed at your tax bracket. So it used to, in the old days, we used to be, every kid would get money, every kid would get a dividend. It was great. And about 10, 15 years, what was it? 2007, I think it was, they changed that. So it's gone. So you can't pay a young child income. And initially it was, you couldn't pay them a dividend or an income. And then some people are like, we'll pay them a capital gain. They caught that too. So now you can't even do that. They've changed the rules. Okay? So you got to get very creative. Now, you can pay your family income, but there's ways, now they have to actually work there. They have to put hours there, okay? Not a huge amount of hours, but they have to work. So this, I don't know if that's considered working today, but but you would have to look at the definition, okay? But yeah, so kiddie tax, you got to be very careful, okay? The other one that comes up a lot is the passive income rule. Now this one is probably going to hit you more often. This one is really important. If you're doing really well, okay, you get taxed on anything let me back up. You're doing well, so you have extra cash in your company, okay? Your extra cash is retained earnings, okay? Retained earnings is money that you've already paid tax on, but it's kept in your company. Well, once you have some retained earnings, some of this extra cash, you're going to want to invest it. You're not going to leave it in your bank account. So now you have a couple $100,000. You say, well, maybe I should put that in investments. Maybe buy some real estate. Maybe buy the building I'm in, right? So you're going to want to invest your money, okay? Well, the problem with this is if you earn any income from those investments or the real estate you own, that's considered passive income, right? Your business is active income, right? Your business is your main source of income, right? You've actively worked for that. Passive means it's just in your sleep you're earning money, which is great, but the government doesn't like that, okay? So here's what happens. For every dollar you earn over $50,000 in passive income, okay, you lose $5 from your small business tax limit. So I'll walk through this again. I'll give you an example. So remember I said, that 12.2%? That's on that first $500,000. Okay? So let's look at an example here. Let's say you had $100,000 of passive income. Okay? The max was 50, right? Like you got for free. So the extra 50 is in excess. Okay? So take that extra 50 times 250, times 5, which equals 250, okay? So now we subtract that 250 from your actual limit. Your limit's 500, we subtract 250, it becomes 250 again. So that means that your 12.2% now is only on your first 250. Okay? So now from 250, you're at 25%. So you've lost that advantage of being a small business because you have too much passive income. Okay. So then, so you're back up to that high amount. Okay. Is that clear? Yeah. Okay. So these are important things because if you're successful, you're going to bump into these things. Now, you have an accountant team here that they're going to say, hey, here's what's going on. They're going to advise you of these things, right? But these are the kind of things they need to pay attention to, right? So what do you end up doing? Instead of when you have that extra retained earnings, before you invest directly, then what you often see is you have that holdco in the middle, right? So now you maybe some of you might have multiple companies. So if you have multiple companies, having the holdco in the middle is great because you can funnel money all into the one company and then invest inside the holdco. Okay? And so the holdco has its own advantages. So you often see holdco for holding real estate, right? I know I have a lot of clients that own multiple properties, and they put each property in its own holdco. Why do they do that, right? Well, if that one property, if the tenants or somebody sued on that one property, it's not going to bring in all the other properties into the lawsuit. Each one is encased. Okay, so you often see that. So it's great for real estate. It's also great for moving money between companies. So if you have multiple companies, you having that holdco at the top makes a lot of sense. Okay. Where it doesn't make sense is you're back up to a high tax bracket again. It's not an active company. So now you're back up to that 26.5%. Okay? And you can't use the capital gains exemption, right? So that exemption that we just talked about, that $1 million of exemption, that is for individuals. Well, an individual doesn't own the company now. Your company is owned by a holdco. Okay? So the question is, well, hold on a second. I don't want to lose my exemption, so I'm not going to do a holdco. Well, no, that's not the answer. The answer is, once your business is worth at least $1 million, then you move it into the holdco. You trigger your capital gains, right? So basically, when you move your company, you basically sell it from you, OpCo, to you, holdco. You trigger $1 million, right? Pay no tax on it because that's free, right? And if it's you and your spouse, you trigger $2 million, right? So when you move it in now, your cost base is $2 million. I mean, if you ever sold your business down the road for $5, $10 million, it starts at $2 million. Okay? So that's when you do the holdco. So if your company hasn't gone to that valuation yet of $1 million, don't even think about the holdco yet. Okay, make sense? Okay. Well, then we get to the next phase. Now we're looking at setting up a trust. Right? Your life is just getting more complicated. Okay? You think that you're trying to simplify things, but it never gets simpler. So the trust has advantages as well. They're great for splitting income with beneficiaries. And that's a really nice way of bringing in family, right? You can bring in multiple family. You can bring in brothers and sisters. You know, they don't have to be shareholders. And you can change that. They can become beneficiaries at any point. You're the settler. You're the one in charge, so you can actually manage who's a part of that. It's also great for managing the assets. So as your assets get more complicated, you have multiple businesses, multiple properties, maybe you need a professional trustee. You need someone to actually help manage it. Especially if you died, they're like, well, my family's not going to know how to manage my estate. You can actually have a professional trustee assist. So it's a great estate planning tool. Okay? Tax-wise, not as advantageous anymore. Okay? But because of the splitting with beneficiaries, you can flow income down to the beneficiaries. You get taxed at their tax brackets. So there is some advantage because now you're spreading it out amongst many people, tax brackets. Okay? But it's also great for control. I didn't put that up there. But if you say, look, I want to leave a bucket of money for all my kids and my grandkids, and it's only for university, you can actually create those kind of rules. This one is to be used for this. Okay? I had a client I spoke to recently. The parents, or I guess the grandparents, set up a trust to pay for the cottage expenses. Okay? So that the kids and the grandkids continue using it, and they don't have to fight about, hey, I paid for half of the fence, you didn't pay. No, all the expenses for the cottage come from the trust. Okay? So there's a lot of uses for trusts. So trusts are very advantageous. But then you have that 21-year rule. Okay? So the 21-year rule, if you're not familiar, basically says that whatever you put into that trust, okay, it's going to grow. It's an you put in investments, you put in real estate, you put in business shares. Whatever you put in there is going to grow over time, right? Okay? Every 21 years, the government assumes you sold everything. So imagine that. Imagine you have properties in there, like investment properties. You have your business shares. You have an investment portfolio. Okay? All of that's in there, and then in one moment, bang, sell it all. You're going to trigger your capital gains, trigger interest, trigger everything. Okay? So there are ways to try and flip that. So if you work with some lawyers, that there are ways to try and minimize that. But basically, that's a major disadvantage. Okay? And there's other types of trust, but that is a big problem. So now we move along to what we're here for, the good stuff, the advanced stuff. So what's the answer? These are all problems. Now, you are moving forward. You can see a little step up. You are moving forward. But like I said, there's still issues you got to deal with. Okay? So let's look at some advanced ideas. Now, I don't know if you've heard of these terms, infinite banking and IFA. IFA is immediate financing arrangement. Infinite banking is a term you're hearing a lot more in the US. It's starting to show up here as well. You know, on my Facebook posts and I don't know, what other social media, you know, you send me stuff too. TikTok, thank you. On TikTok, I'm like, I don't know, all of them, yeah. It's starting to show up. So I'm starting to see a lot of people talking about this stuff. So you need to be aware of it, okay? So what is this? So basically, we're going back to that same scenario where you had, you know, your holdco set up. And whether you have it or not, I mean, it would work. But basically what we're doing is, before you take your money and invest it, so you're going to invest that. When I say investment, that could be, you know, investment portfolio, it could be real estate, it could be your own business. Your own business is a qualified investment. So before you do any of those things, we're going to add in an extra strategy. What we're going to do is we're going to move the money into this infinite banking strategy first. Okay? The infinite banking, I'll get into a lot more detail, but basically infinite banking is set up your own bank account where you're the banker and you're in control of it. It's much more powerful that you never have to go back to a bank. I've used this for a lot of other clients, and I'll give you a few more examples in a little bit. Once that's set up, then we turn around and we do the IFA, which is immediate financing arrangement, okay? Which means we borrow it back out and we give it back to ourselves. So what we've done now is we've managed to use the money 3 times. Okay? And it's back in your hand, and from your hand, it goes back to the real estate. So now you still got the real estate that you wanted, or the investment that you wanted, but you also got these other 2 facilities set up. So what good is that? So let's look into what do you do with those. Okay, let's start with infinite banking. So step 1, we have these corporate retained earnings. And now I'll give you some specific numbers in a bit, but this is just general. So we have corporate retained earnings. We move them into a whole life policy. So we're going to take advantage of an insurance policy called whole life. And I'll have another slide and I'll get into that. But basically, whole life, we're using it not for the insurance, we're using it for the tax shelter. So it's a unique product that actually has a tax sheltered component. So any extra money we put into it grows like an investment, but it grows tax sheltered like an RSP or a TFSA. So it's very unique and very powerful, okay? For that, you get 2 parts. You get the life insurance and you get that cash value, this tax shelter. The life insurance, if something happens, it's paid tax-free. If this is done corporately, it's paid to the company, and then it's paid to your estate tax-free. The cash value is all tax sheltered, and it's also paid tax-free. So, you know, if you died, your family gets all of it tax-free. Okay? Now, that's important because this has all been corporate money. Okay? And we're going to be moving dollars, actual dollars, into the investment component. While it's tax sheltered in here, it's still a corporate asset. But if you died, all of this money, plus the insurance, all of it comes out of the company tax-free. Okay? That's massive. Okay? It's a nice way to get money out of your company. So let's look at some specific examples. Oh, sorry. I mentioned a couple of terms. So whole life insurance. So whole life insurance, this is permanent life insurance. So you might be familiar with, if you had a mortgage, you had some term insurance, like 20-year term, right, 10-year term. Term insurance is for a certain period of time, right, for 20 years, and then the rates either go up or the policy cancels, okay? Permanent life insurance is for your whole life. We lock it in for life. It doesn't matter if you live to 90, 100, 120. It's a permanent policy. You're covered for life. Okay, so that's important. Creates this tax-sheltered investment account that we're going to take advantage of. And the best part is that cash value, that investment, it's accessible tax-free anytime. So even though you're putting money into the policy, it's still liquid. You can still pull it out. You can create income streams from this. You could pay for kids' education. Like, there's so much you can do with it. Okay, it's still liquid. And it creates this thing called the capital dividend account. Okay, this is more for the accountants in the room, but basically, this is how the money comes out. So when a death benefit is paid, so if you have life insurance, okay, if you have a personal policy, life insurance is always paid tax-free to the beneficiaries, period. Okay? But if it's corporate owned, it's a little trickier because it's paid tax-free to the company. Well, how does the company get it out? Well, when the money is paid tax-free to the company, it creates what's called a CDA, a capital dividend. A capital dividend is basically a tax-free dividend. Okay? So if the life insurance is a $4 million policy, it creates a $4 million CDA that you can pull out tax-free. So there's an extra mechanism to ensure that policies remain tax-free. Okay? I apologize if I get too technical, but it's a good term. Now the cash value. Now this is interesting. So this is really why we're doing this, the tax-sheltered cash value. So the tax-sheltered growth. Now it is similar to an RSP or TFSA, meaning whatever it grows by, it stays inside the policy and you never pay any tax in it. Okay? Now if you were to cancel the policy, there could be some tax issues, but we're not going to recommend that. We have some better ways to access this. Now, with these policies, these are whole life policies, you're actually considered a shareholder of the company. So when you buy these policies, because you're a shareholder of the company, they pay you a dividend, right? No different than if you bought BMO shares or RBC shares, right? They pay you a dividend, okay, because you're a shareholder. So by buying a policy, you become a shareholder. Well, the dividend rate right now is about, actually, I think it's 6.2% right now, okay? I think it got down to 5.5% in the worst market, okay, a few months ago. So it's never been lower than 5.5%, and they've always paid a dividend. In over 100 years they've been around, they've never missed a dividend, and it's never been less than 5.5%. Okay? In fact, it's been much, much higher, but in the last few years it has come down. Okay? So this is what you're getting, and consider that these rates are tax sheltered, so they're actually better than that. Okay? All right. Now, that was the infinite banking part, okay? That was just getting it set up. Now, how do you access it? That's the second part. That's the IFA, the immediate financing arrangement. So what that does, it now says, look, you're going to put this money into this policy, and generally when we do this, our clients sometimes do considerable amount in there. I've done, sometimes a few $1 million, okay? So there's no limit to what we could do here. So you're going to put money into this policy, but if you do it this way with the IFA, we're going to loan it back to you. So you put in $100,000, $200,000, whatever you put into the policy, all of it gets lent back to you. Okay? Once you got it, you get to invest it. Remember that example of the real estate you wanted to buy? You got the money back. So you get to invest in real estate. There's no limit. Okay? Ideally, we're going to recommend you invest in something that's a tax-deductible investment. Okay? You can invest in a cottage, but now you're not getting that tax saving. So the math looks much better if you can deduct the interest. And it is a regular investment, so it's paid to your estate, but it is taxable. But let me give you some actual examples with some real dollars so you can see how that works. Here's one I did recently. It was an individual who was going to put $250,000. That's what he had in retained earnings in his company. Okay? And he was saving about that much every year. So every year he had surplus $250 every year. Okay? So we took that $250 and we moved it into a whole life policy that you paid $250. Now this is year one. So this is over 10 years, and I'll show you what happens. So in year one, he puts in $250 into the whole life policy. Right away, and this guy was 46 years old. Him and his wife were I think she was maybe younger. So they're in that 46-year-old range, okay? So right away, it bought him a life insurance policy of $4.2 million. So even if everything goes wrong and they died suddenly, they already turned their $250 into $4.2 million, okay? So that's insurance, right? So that's the risk that insurance takes on. Now the cash value in the first year was only $172. Okay, so it's short of the $250 because some of it was lost to actually buy the $4.2 million policy. Okay, but this is going to catch up, and I'll show you what that means. But we lend them the full $250. So even though the value of the policy or the collateral is only $172, we're going to lend them the $250. That difference between the $250 and the $172, the client is going to put up a personal guarantee, a personal collateral, just for a short time, okay? For a few years until this collateral exceeds this. So it's usually about 5 years, and then we no longer need a personal guarantee, Okay? Now, we could, if the client doesn't want to do a personal guarantee, we could lend the 175, sorry, 172 with no guarantee. We could do that as well. But most clients like the idea of I give you $1, you give me $1. That makes a lot of sense because then it doesn't cost anything. Okay? So I give you the 250 back, and you invest it. You invest all of it. Do whatever you want. Right? We're not going to dictate how you invest it. Okay? As opposed to, we're just going to say, though, you should put it into something that is tax deductible, but other than that, we're not going to really manage that.
Could you spend it?
Personally? Mm-hmm. But then no tax deduction. So you can do whatever you want. You could actually travel. You could do whatever you want. You can take it as income. But then my math here is about you taking the interest and having a tax deduction. Okay? But it does still work without tax deductions. Yeah.
So yes, you can spend it.
So yes is the answer. Okay? After tax, this investment here is worth 141. I just want to show the total value. So why it's 141? Because this is corporate dollars. So I'm imagining that if you died, you'd have to take the 250 out of the company, pay tax, and so forth. So really, it's only worth 141 personally. Where this one up here, if you died, it's 4.2 million minus the loan. It's $4 million. Okay, so together, in year one, you're worth 4.1 million. So right away from year one, you've taken 250, which if you didn't meet me, you would do this. You would do this, and you'd have 141. Okay? By working with me, you got 4.1. Okay? So that's just year one. So now let's fast forward. Let's go 10 years. This was for this client, this was a 10-year strategy. And this, we could design it 5 years, 10 years, 20 years. It really depends on your cash flow and your goals. So this client was doing 250 times 10, right? So $2.5 million they're going to contribute to the policy. That year, in year 10, the 250 goes in, so a total of $2.5 million. By this point, the policies, it's continued to grow. So the $4 million insurance has continued to grow. It's now $8 million. The cash value is 2.7. Now the collateral, all we need was 2.5. So now this client no longer has to provide a personal guarantee. So that's off the table. Okay? So we have value of 2.7. We lend him $2.5 million, which is what he's put in. And he's taken that 2.5 and he's invested that back into his whatever he wants. Okay? And this, I want to reiterate, this 2.7 million, that's real money. Meaning, if you decided in year 10 here, like, you know what, I don't want to do this anymore. I mean, this was only a 10-year strategy. He didn't have to pay anything after this. But if he changed his mind, he canceled the policy, that 2.7 million is a real investment. We would pay that back to you. Okay? It would pay off your loan, and you still would have your outside investment. The outside investment here, earning, I think I did 6%, is $3.5 million. Okay? $3.5 million corporate investment is worth about $2.2 million, personally. If you died here, you have the $8 million minus, we still have a loan, 2.5, you have 5.6. You have almost $8 million. Again, if you do this on your own, you will invest your $250 corporately, you'll have 3.5, you'll be very happy. You'll only have 2.2 after tax. But by doing it this way, you have almost 8 million. This is how very affluent people multiply their assets. Right? You're using the same dollars twice. Okay? Let me fast forward one more example. Let's go to year 85. No, sorry, age 85. So now this client has this strategy. They've only done those 10 payments. Okay? They haven't contributed anything else. The policy has now grown to over $13 million. The cash value has grown to $11 million. The loan is only 2.5 because this client is servicing the interest. Okay? So they're still paying the interest because they are getting tax deductions, so this still makes sense. And it makes sense, like once we get into the math, I didn't put that in this slide, but when you look at the cost of the interest versus the value the policy is growing by, the interest is nothing. Okay? It makes sense to keep paying the interest. Because look, you can actually borrow more. You only borrow 2.5, you have 11 million value. Okay? Your outside investment has continued to grow. I assume you did very, very well. You turned into $22.5 million. Okay? But $22.5 million corporate is only 17. But you add in my strategy to 13 minus 2.5, 10. So now you're at 27. So again, you could do well on your own, right? $17 million. But that's being optimistic that you've earned 6% year in, year out, no matter what. What if the year that you wanted to use this money, what if the year that the market went just crap, and that 17 million disappeared? You still have 10. Okay? So it's a good insurance. It's a good backup to what you're going to do anyway. I'm not going to change how you invest. Okay? So basically what you're seeing here is that 250, you're getting the infinite banking and IFA for free because you're still doing what you're going to do anyway. But for that, you're getting a life insurance policy of 4.2 million to start, which obviously grew. You're getting a dividend of 6.25 right now. That's the current rate. It's actually just increasing, and I think it'll continue to increase over the coming years. So you'll always get the current rate. Okay, so right now it's 6.25. You're getting a tax-deductible loan, which the net cost of the loan is about 3 to 4%. So right now interest rates are high for loans. We get that. Okay, so right now if you did this, the rates are prime. So what's prime now? About 7.5? It's high, right?
Yeah, it's 6.8.
6? Okay, it's close to 7%. So 7% after tax is about 3-4% after deductions. Okay, so if you're earning 6.25, but you're paying 3, you're already ahead. Plus, hold on, you still have the money outside that you've invested in real estate, and so that's going to earn 7, 10, 12%. Plus all of this. That's not even in this list. Okay, so it works very, very well. Here's the example. So if you did this just investing on your own, this is what your estate is worth at 250 times 10, so that $2.5 million. If you invested it by the time you're 80, you have about $7.5 million net after tax in your personal hands. If you did it by adding the infinite banking, by age 80, now you're at $13 million. You 82% increase. Okay? But if you did all of that with IFA, 7.5, 13.8, 22, 200% increase. Okay? So you're basically getting all of it. This is one of those you can have your cake and eat it too strategies. Okay? And I know you're probably thinking it's too good to be true. This works, has worked for a very long time. It uses the insurance laws, and the insurance industry is a very, very strong industry. Okay? They haven't changed their policies in a long time. They did change them, I'll admit, is about 15 years ago. The government stepped in and said, hey, this tax shelter is too good. Right? There was too much money in these policies. Right? For every dollar of insurance cost, people could put in $20 of investment. So it was people were maxing out. It was much more of a tax shelter than it is today. So what did the government do? Instead of shutting this down, they said, oh, well, it's too rich. We're going to drop those ratios. So for every dollar of cost of insurance, you can put in $10 of investment. So 15 years ago, it was better, but it still works.
When they changed it, did they grandfather it or?
So anyone that had bought the policy prior to that change, the policy was grandfathered. It was not changed. So there's a lot of people out there that still have those 20X policies, which is unheard of. Okay? So it's great. And yeah, exactly. So should they change in the future, they're not going to change your policy. Based on history, that's what they've done. So all of this, though, is based on an insurance policy. Okay? Which I was going to say, exactly. You still do need to qualify for. Okay? All of these numbers I based on that couple, that 46-year-olds, as a joint policy. Right? As a joint policy, it was a joint last to die, meaning if both husband and wife passed away, then it would pay out the death benefit. Right? Joint last to die just makes the cost of insurance lower because there's two people that have to die before it pays out. When you start out in life, you probably have that term insurance, and it's probably single life. It's probably on each of you, all right? Or joint first to die, okay? Most likely single life. But as you get older and you're more concerned about estate planning and what happens when I die, then we look at last to die, which is going to lead me into the next section, which is we're going to talk about estate planning, okay? And specifically estate freezes. Okay, so I want to touch on this thing called an estate freeze. And an estate freeze is an important topic because when you started your company, you're probably early days, and you probably just set it up under yourself, right? You were the only shareholder, and you probably didn't even think, oh, I should have brought my wife in, or should have brought my kids in, right? So your company continues to grow, but you're the only owner. Well, the problem with you being the only owner is if you ever sell the company, you only have one capital gains exemption. All right, so that doesn't work. So you want to create the opportunity to have more of them. So here's what it looks like. So let's say we have mom and dad, and they're worth about $1 million. Okay? So that $1 million could be non-registered investments, real estate, their cottage, or their business that we're talking about today. If they were to pass away, $1 million, the ACB, let's say, the ACB meaning the cost base, let's say it was worth, they started with $200,000. So that means $800,000 is the capital gain, $400 is taxable, they owe about $200 in tax. So real simple, okay? So in this example, that $1 million could be made up of anything. For here, let's just say it's your business. Okay? That money is moved into a holdco. Okay? Look at that. Okay? It gets moved into the holdco. Now, this could be for you, you have an opco, then we can actually move it into a holdco. Now, if you already have a holdco, or if you already have an opco, there's different ways to do this. There's either we set up a new company and we roll over everything, or we reorganize your existing company, okay, reissue new shares. So there's different sections of the Tax Act, Section 85 or Section 86, depending on how we're doing it. It's the same either way, okay? So now you have this holdco. So this is today. So this is not in contemplation of the kids. So if something were to happen to this mom and dad, they own all the preferred shares, okay? And the kids would get common shares, okay? So this is us redesigning the company, okay? Or setting up a new company. It's already worth $1 million, so that $1 million continues to flow down. It's still owned by mom and dad, okay? But they take on preferred shares of the new company or the new structure. Now we bring in the kids. The kids have no value, market value of $1. So that's all we've done today, is just kind of reorganize your assets. Now, it could be a company worth $5 million, $10 million, whatever it is, okay? This is just one way. So right now, nothing changes. You got preferred shares. Now, preferred shares, when you set this up, have a few interesting attributes. Preferred shares, first of all, have a fixed value. So when we did this, we just said now they're worth $1 million. Well, that's not going to change. It's a fixed price, okay? That's one. Two, preferred shares, in this example, they have all the control and all the votes. So you're like, well, I'm still running the company. I don't want to give my kids any shares because I'm running the company. I'm in charge. Oh, you still are. 100% of the control is over here. Okay? So nothing's really changed. We've reorganized your shares, but nothing's changed. So now let's fast forward. So let's go 20 years from now. What was the impact of this state freeze? Okay? So now we have a company that's now grown. Now it's now worth $4 million. The cost base was still 200, right? That was what we started with. It hasn't changed. The capital gain is now 950, which is, or sorry, the tax is 950. The capital gain is 3.8, right? Half is taxable and then half tax again. Okay? So you have about a tax bill of 950. All right? Here's the setup we had, right? The preferred and the common. The preferred was the parents, and the kids were over there. Well, what's the preferred shares worth? This is the quiz time. No. They were fixed.
Oh, the 2 million.
1 million. The preferred are worth 1 million. Nothing's changed. They're fixed. So it means all that extra growth is over there at the kids. But you still have control. Even though the kids' shares are worth more than yours, you are still in control. They can't issue a dividend. They can't even, well, they can attend the board meetings, but they don't get a vote.
They can kick you out.
They can't. Okay? So what does this mean for tax, though? So parents, now you died. Sorry, you are going to die someday. Okay, so that $1 million valuation, that flows to your estate. Come on. All right, the tax bill, oh, sorry, hit too many times, slow down. It's really slow. Okay, your tax bill is $200,000. That's the same tax bill from 20 years ago, right? We froze your value, we froze your tax. So now, you guys are gone, so your preferred shares get either canceled or get transferred to the kids. Now they get control. Okay? Now, that $3 million, come on. So now they have a company worth $4 million, because now they got the whole value, the company. Let's go. Oh my God, this is so slow. Their new ACB is $1 million because you just pay tax on $1 million in your estate. So their cost base is $1 million, which leaves a tax bill, oh my God, $750. There you go. So this $750 now isn't due when you died. It's due when they die. Okay? So what you've done in estate freeze, you've postponed the tax for another generation. You haven't eliminated it. You've got to get more creative, more advanced stuff, but that's already huge. And hopefully, by the time they die, hopefully we're down from 53%, maybe down to 52. Okay? So the benefits of an estate freeze, that if you did nothing, you would have owed $950,000 in tax. Okay, if you did nothing, you still would have had control of both full control of the income and the control of the company. Okay? By doing the estate freeze, you only pay $200 and you've given up nothing. Now then what you would do is you would buy a life insurance policy to offset that $200,000, right? Because now it's a fixed amount. Now you can plan for it. The problem before is that $950 was growing. So you have to buy a policy that grew. Now you can just buy $200. Okay? Now, you'd multiply this depending on what your numbers are, right? Maybe it's $2 million for you or whatever it is. Okay? But it makes planning for your estate much more manageable. Okay? And then once the kids are older, we do a refreeze. We do it again and bring the grandkids in and just continue doing that on and on. Okay? So this is part of the more advanced stuff that I really enjoy. Okay? Last one. We've talked about how assets are taxed, and let me just bring them all up here. So a lot of this we've already addressed, and you may already know, but your principal residence is tax-free. So always buy the biggest house you can afford, right? Because whatever it grows by is tax-free. It's awesome. It's another nice tax shelter. Okay? Your cottage or second property, fully taxable. You only get one principal residence, and it's only one principal residence between spouses. Years ago, when I started this industry, you used to get 2 principal residences. Each spouse can have an exemption. I know, and they got rid of that. I thought that was a good idea. Okay, business shares, also capital gains. Stocks, mutual funds, all capital gains. 50% now, and that's the other thing. Don't take that for granted. There's been talk about moving that back up to 75%. So meaning if they did that, 3/4 of your growth would be taxable as opposed to half. So they are talking about that. RSPs, fully taxable as income. Now I know we often gravitate to an RSP because we get that tax savings up front. But I'll tell you this right now, you should only be doing an RSP now if you expect your income in retirement to be less than your income now. And I don't know anyone who plans for that, okay? So if you expect your income to be high in retirement, then you're not going to be at an advantage. Because you're saving, think about it, you get a savings on $20,000, $30,000 when you contribute, but you're going to be taxed on $1 million on the way out. Or would you rather do a strategy where you maybe don't get the tax savings on the 20/30, but you pay nothing on the $1 million, right? So you kind of got to look at the big picture. So you may have outgrown an RSP potentially, okay? And if you have, there are other things we could look at like IPPs, we can look at RCAs, and we can even look at whole life policies with income. Okay, so there's a lot more interesting things. Tax-free is cash, life insurance, and TFSAs. Okay, plus probate. Okay, you guys know what probate is? I didn't think I kept that out. But probate, I just right at the bottom there, I added plus probate. A lot of people get freaked out about probate. Probate isn't a huge amount, it's about 1.5%, but it gets taxed on your entire net worth. So even though your, let's say, principal residence is tax-free, if it goes through probate, I say if, because there are ways to get around it, but if it goes through probate, you're going to have to be taxed at 1.5%. Okay, so it's an additional little tax, and that is by province. Each province is different. So Alberta, for example, I believe they just got rid of their probate altogether. So if you have significant net worth, and you want to save that 1.5%, move to Alberta. Okay?
But life insurance doesn't have to go through probate.
Yeah, exactly. Yeah, so life insurance, what she's saying, with all my examples, life insurance skips probate. Okay? Seg funds, if you have a choice between mutual funds or seg funds skips probate. So there are ways we can get creative about that. Let me give you an example of what we do when it comes to estate planning. So let's look at this married couple, two 47-year-olds. They've accumulated a net worth of $3.7 million. They have a home about $850,000. Clearly not in Toronto, because you can't find it anymore. That's not even a tear down anymore. Properties, $2.7 million, so that's their cottage and an investment property. On that, their cost, their original purchase was $790, and they have about $150 in RSPs. Okay? So you can see very quickly, $3.7 million is not a lot anymore. Okay? Current net worth, $3.7 million. If they die today, they already owe $550 in tax. Okay? The RSP is half, so $75,000, plus the capital gains. And probate is in there as well. Fast forward to age 85, 5% growth rate, they're worth $21 million. Okay? Now they owe $3.9 million. Right? And it's funny, because I talk to clients about this. They're going to owe 3.9. I'm like, how does that make any sense? I'm only worth 3.7. Right? But, that's the time value of money. They got, they're only 47. They got 40 years ahead of them. Okay? So what are your options? Well, options one is do nothing. If you do nothing, you owe $3.9 million. Comes right out of the estate. That may seem like a simple strategy because they're worth, what did I say they're worth?
3.2.
No, $21 million. They're worth $21 million. So like, well, I'll have clients that say, well, I'm worth $21 million. So who cares if I pay $3.9 million out of the estate? My kids are still getting way more than my parents left me. You've heard that before, right? Yeah, exactly. But here's the problem. $3.9 million. What's the chance they're going to have that in cash? Right? They have their home. They have their cottage. They probably have maybe a property down in the US or Europe, right? Maybe they have their investments locked in. They're not going to be liquid. Anyone that's got $3.9 million kicking around, they're going to invest it. Okay? So now, CRA said, hey, you owe us $3.9 million, you've got 90 days to pay. Real estate market is down. It's not the best time to sell. Right? So now you're going to sell, fire sale. Right? So you see what I'm saying? Now you're going to put your family in a very difficult situation. Okay? Or what if the value, like most business owners, 90% of your net worth is your business. Now you got to sell the business just to get the money to pay for this. So paying from the estate while there is an estate may not always be practical. Another option is you can start putting money aside today. Okay? Knowing that we just identified you owe $3.9 million. If you started saving X amount today in a separate fund, I worked it out. If you save $1.5 million, earn 6%, it'll grow to $3.9 million over 40 years. Okay? But guess what? You got a new problem. That's taxable. You just created $3.9 million, so you actually have to save more than that because now it becomes a taxable event as well. Okay? So you can't get around this. You can get a loan, meaning your estate, your executors say, listen, I don't have the $3.9 million liquid. Can I finance it? So CRA will actually allow you to finance it either with them or you can go through a bank. Probably makes more sense to get it through a bank because CRA will charge you prime plus 3. But at least they will allow you to finance. So if you have to finance in the year of death, you're going to end up paying an extra $1 million on a 10-year loan. Okay? But it's an option. But here's the other part. If you're still paying the CRA back for the taxes, they're not going to let you distribute the estate until the debt is settled. So now you've tied up your estate for 10 years. Okay? And maybe that's the only option. Charitable giving. We haven't touched on that, but you could donate in the year of death. So your executors, or even you in your will, can say, hey, I want to donate to a charity. But in order to save $3.9 million, you got to donate double. You got to donate almost $8 million to save 3.9. Now, there's some value there because you've given $8 million to a charity as opposed to giving $4 million to CRA. So some people kind of like this strategy. Now, these strategies are not mutually exclusive. You can do a little bit of this, a little bit of that, right? And then we have our little insurance guy over here, right? When you know that you're going to owe $3.9 million, you can buy a policy that says, when I die, it'll pay $3.9 million. And the total cost of that policy over all the years you pay for it, $760,000. It's much, much more economical than doing nothing. Because if you did nothing, you would owe 3.9. So when clients say, like, I'd rather just do nothing, that's an expensive proposition, doing nothing. Okay? Here's what it looks like. So I did some examples here based on what you might owe. So if you owe $2 million, $5 million, or $10 million, okay? Depending on what age you are. So I'm in my young 50s. If I were to buy a policy for myself, let's say $5 million, it would cost me $96,000 a year. Okay? Now, this is a 10-year policy. So the total cost, there it is. So for me, a $5 million policy, total cost would be $1 million. So it's 1/5 of the actual estate value. Okay? So it would be, yeah, so here we go. I'd be paying 19% of the total bill. So wherever you are, if you're in your young 30s and you wanted a $10 million estate, here's another way to look at this. So imagine that, forget the tax bill. What if you want to leave your kids $10 million? Just buy a $10 million estate. Buy a policy that pays $10 million. You're in your 30s. It will cost you $836,000. That's it. And total payment. And you guarantee no matter the markets, no matter what happens, your kids will always get $10 million. Okay? And now you can take risks in your business knowing they're protected. That's what insurance does. It's the leverage of time, right? Look at the 80-year-olds. We're like, oh, some people say they're too old. An 80-year-old can buy a $10 million policy, $4.5 million. Still half. If you use the rule of 72, I don't know if you're familiar with the rule of 72. The rule of 72 says that your money will double. If you use 7%, it will double in 10 years. If you use 10%, it'll double in 7 years. So it's the rule of 72. So at 7%, your money doubles in 10 years. For them to take $4.5 million in 10 years, it'll take 10 years to be $10 million. Okay? They're 80. Mortality is 82, 83. It's a good investment for an 80-year-old. And you guys don't look like you're 80. Okay? It works. It works really well. Oh, wow. We're done. So what we do with our clients is we do a financial plan for you. Okay? So that's included for everyone that came today. We would do a full financial plan. Before we would decide on what's the right strategy for you, we want to know who you are. What are your goals, right? And then from there, we could decide on what's the best action. Today, we have here myself, George. I'm a certified financial planner. I'm considered the expert at our company and in the industry. So I was speaking today. Diana and Kirk is over here as well. So we'll be here. Kirk is our president. If you wanted to book a meeting, reach out to Diana or myself, okay? And we can definitely set that up. But we'd love to chat with you. I don't know if any of these strategies are right for you or if it's the right stage, but at some point it will be the right stage. Okay? Maybe it's not today, but you need to know about these things before you're ready.